Hey traders, today we're going to be taking a look at how to trade an iron condor on a stock over earnings. Before we do that, just a quick disclaimer that everything in the video is for educational purposes only, is general in nature and does not take into account your personal circumstances. So the stock I'm going to look at today is CHWY, which is reporting earnings after the close today. And we're setting up an iron condor, expires on June 3rd. Now, what we want to do is we want to try and place the condor roughly at the expected move of the stock. How do we know what the expected move is? Well, we can calculate that pretty quickly, and I'll show you how to do that. So basically what we do is we take the stock price, let's say it's 24.80, then we add together the at the money call and put for that particular expiry. So let's take the midpoint. So we'll say 229 plus 244. Gives us an expected move of plus or minus about 473. So the market is expecting the stock to stay in a range between about 20 and 29.5. Okay. So now that we've got that information, we can set up our strikes. So we're going slightly inside the expected move at about 21 and 29 for our short put and short call. And you can see here, that's about 16, 17% on the upside and about 15% on the downside. So right around that expected move. If the stock stays within the expected move, these options will all decay and we'll hopefully achieve the full profit here. We're trading two contracts, two strikes wide. So risking about $250 to make about $150. The reason it's $250, normally if it's two strikes wide and two contracts, it would be $400 capital at risk, but we reduce that by the premium received. So 400 minus the 150 gives us our 250 max risk, 150 potential gain. So 150 over 250, that's potential for about a 60% return in a couple of days. Obviously, it's not without risks. Trading these sort of condors can be quite risky, certainly not recommended for beginners. When it's such a short-term trade like this, it's very difficult to adjust it if the stock does make a bigger than expected move. You've also got to be aware of assignment risk. So if the stock makes a big move higher or lower, gets through the short strike, you can potentially get assigned on the short calls, let's say on the upside. Now, if it goes all the way up through 31, the long call that you own will kind of offset, and the most you can lose is still 350. That doesn't change. Where it can get into a little tricky situation is if the stock ends between 29 and 31, where you might get assigned on this option, but this option isn't going to cover it. So that's just one little thing to keep an eye out for. Again, if you're a beginner, probably best to just paper trade this and see how it goes. All right, hope you enjoyed the video and the trade idea. If you've got any questions, just let me know.